involved. So talk to us about how do you finance these projects? Obviously, you're talking about scaling, growing your business. At some point, you're going to run out of your own money. So you're going to need to bring on potential investors. How do you structure that? If that is something you're looking to do or you're currently doing, how do you structure it? Do you structure it to a JV? Do you structure it through, limited partnership? Do you structure it through ownership shares where, there's a corporation and investors and partners receive shares? So tell us about that, and we'll ask you some more questions.
Yeah, it's an interesting thing, and it's probably the number one challenging thing with this style of investing is because, for instance, our first projects that we bought this year, Oakmount and Dovercourt, were both residential houses, right? So when we're going in, we're saying to the lenders, okay, well, it's a single family dwelling. So can we get single family dwelling financing, right? But we have to, and the lenders are saying yes, for the most part, right? If it looks like a duck and quacks like a duck, it's a duck, right? So they'll say, we can give you 1.75, 30-year amortization, as long as we can qualify. But the problem with that is they don't like to see corporations on title on a residential mortgage, right? And we want to go in thinking about the future of the building, not this short-term, the next 12 months and getting 1.75% interest on our financing. So we had to look at some alternative options. We were actually able to go to National Bank and get residential financing with a corporation. And we put 3 of the shareholders on the corp that had the strongest qualifying capabilities. I was not one of those people because my debt service ratios are all over the place.
Like all of us.
Yeah, exactly. But what we did then is once we closed on the property, we can start to add the other shareholders in and let the bank know, and they're not so concerned about it. And then on the back side, we've already got the corporation set up. So when we're finished the renovation and now we're going commercial financing, well, the commercial lenders are used to seeing corporations and shareholders and all that on a regular basis. So they don't balk at it at all, right? So that was the structure that we worked under on our Dovercourt and Oakmount project. We kind of went in, purchased residentially in a corporate structure. And then on the backside, we're doing commercial financing with a shareholders agreement. Our new projects, we've switched to a limited partnership just because it's a little better when it comes to financing and the benefits to the limited partners from a tax perspective, from a liability perspective. And so our 2 new projects we're purchasing under a limited partnership. It's a little more challenging on the front end, like I say, to purchase in residential financing. But honestly, I don't really care so much if I'm paying 2% or 6% on the front side, because it's such a short amount of time in the lifespan of the investment that, if we're paying an extra $30,000 or $40,000 in interest, it's not going to make or break our projects.